We're joined by Nathan Lim from Lonsec. So this will be a hopefully really interesting and enjoyable session, and really informative on what's going on in the investment markets and with the economies, and how portfolios are being positioned, and a whole range of things that Nathan will cover. Just a little bit about Nathan. Nathan's the Chief Investment Officer for Lonsec Holdings, and he's responsible, I've got here, for building and managing Lonsec's suite of investment solutions and devices strategies for growth. Despite the way he looks, he's had 30 years of experience in investment markets, so must have started really young, in roles, sort of a variety of roles, spreading from North America, the Middle East, Asia, and then into Australia. We were just talking about that sort of structure. So he's gone different ways, but on the end, he's ended up here. And we were just talking about he's now an Australian citizen and has an Australian accent, and as do I, being English. So there's many Australian accents out there. So today, Nathan will be running the session. Just a couple of points. There's the opportunity to ask questions, and on the top of the screen, you'll see a thing that says Q&A. If you have a question and you'd like to, as we're going through the presentation, just want to jot that down, and we'll get to all the questions at the end of the presentation. And at the same time, we'll ask anybody if they have a question, then you can just sort of shout it out at the time, and we'll be quite flexible around how we do that. That'd be good. Just one thing on questions. Nathan's obviously happy to answer anything on the broad investment economics spectrum, but obviously he can't answer any questions on specific stocks and whether we should buy or sell them. So just sort of raise that in case you think about asking that question. So look, for the next half an hour, 45 minutes, we'll hand over to Nathan. Enjoy the session, and we'll come back for questions later in the session. So over to you, Nathan. Thank you.
Thanks, Nigel, and thanks for everyone for taking the time to hear us speak. So I'm going to take about the next 30 minutes or so and talk about Lonsec's view of the world. So it's basically a breakdown of how we see the macroeconomics, and then how that then translates to how we think about markets, and then ultimately how that translates to how we're positioned in client portfolios. Just to qualify that comment earlier about stocks, I can't say buy or sell, but if you want to ask a sort of macro question about, say, iron ore and its implications for BHP, I'm happy to touch on stuff like that, but don't ask me to please start picking stocks, because the compliance people over here would be very, very unhappy. So I'm going to throw a slide deck up here, and we can kick off with that. So let's see. Can you guys see all that? Okay, great. Got thumbs up. All right. So just very quickly, for those of you who aren't familiar with Lonsec, or you may have heard of Lonsec, we have been around for about 30 years. Our principal product or service that we did for many years and continues to be number one is our Lonsec Research. So we are number one in the country for doing funds research. So if you want to know anything or everything about any fund manager in this country and how good is their product, you talk to Lonsec Research. That's not me. I'm actually Lonsec Investment Solutions. So I'm actually on the other side of the business, where we run our managed account business, and currently we have around $10.5 billion in FUM. What does managed account means? This is managed accounts. Basically, we focus and specialize on offering solutions with everything from ready-made, off-the-shelf SMAs all the way through to tailored MDAs. So we are very much in the research and implementation of best ideas for client portfolios. All right, so this is the summary of today's presentation. I don't want you guys to read this now. I want you guys to read this later. Okay, so at the end of today's presentation, we will make this slide deck available for everybody that they can look at on their own leisure. These are the key points that we're going to be touching on from the slide deck. Okay, so let's get into it. First and foremost, let's put things in a context. Lonsec is still very much in the belief that we are going to achieve a soft economic landing. And by soft landing, what we mean by that is we're using the definition of the former Fed Governor Alan Binder, who defines a soft landing when you have economic growth between -1% and +1%. So that's basically between a mild recession to very mild growth, right? Now, when you look at country level statistics or country level forecasts, what we've seen happening over the last several months is a decisive turn for the better for consensus estimates for GDP growth. And so when you look at it at the country level, it's actually quite interesting, but it gets even more interesting when you start aggregating it. And so that's what that chart on the right is talking about. So if you look there, if you look at the G7, for example, remembering that the G7, the Canada and the like, make up 44% of the world economy, you can see that economists are basically calling for sort of muted but flat growth between now all the way through to 2026. When you also include the Asia Pacific, which includes India and China, that's like another 30% of the global economy. What this means is that economists are saying that 70% of the world economy is already expecting growth that is outside of a soft landing scenario, right? And so now we know that economists, they can change their mind, forecasts can move around, but then we can then look at more contemporaneous forward-looking data, and this is where we look at Lonsec's dynamic asset allocation cycle model. And what you can see in our model, and that's what the chart on the bottom is pointing to, is that you're starting to see a real greening in the statistics. And so what we've done is we've taken out just a part of our model to show you guys here. And what we're demonstrating, what we have on screen right now are the Purchasing Manager Index composite reading. This is a very simple chart to understand in the sense that basically whenever you have when the composite index is above 50, it's green. When it's below 50, it's red. Now, obviously, the higher above 50, the greener it gets and the better it is. And so to help you understand this, take a look at the 2022 third quarter or Q3 and fourth quarter or Q4 period. So this is 2 years ago. Look how red it was. Arguably 2 years ago, we could really make the case that, you know what, we're on the verge of a recession, right? Things are getting real bad for both manufacturing and the services sector. Now you sort of fast forward to today and you sort of move your eyes to the right, and this is what we mean by greening. You can clearly see that things are going from deep red all the way to like light green. And that's actually very, very good. Now, of course, if you really want to squint at it, you can always find that one exception. And yes, France is actually worse today than it was 2 years ago. But the point we want to make here is that clearly the direction of travel for the macroeconomic economy based on real-time data is supportive of what economists are forecasting from the chart above. Things are improving. Right? And I think that's the key message that we want to get across. And what this says to us is that the odds of a hard economic landing, so this is sort of like a GFC-like recession, or any sort of recession, seems really unlikely to us and is becoming more remote. Now, what this means is that at this point in the economic cycle, which is still late cycle, this is kind of like the mildest sort of slowdown that even me in my career I've even felt. Yes, I'm actually 51 years old and I have kind of seen a few recessions, and I can tell you from my perspective that this is pretty much the best recession that I've ever lived through, if we are indeed even in one. It's fantastic, right? So the bottom line here that we're trying to get across is that macroeconomic conditions right now and on looking forward look pretty good. And what underpins all of that, quite simply, is employment, right? If we collectively still have a job, and remembering that unemployment in Australia or pretty much in the whole developed world is at all-time lows, how do you get a fall off in spending? How do you get a rise in bad debts if you got a job? So that's what's holding this all together. And just as one, and I don't want to belabor this point, but just one final point I want to make on this, let's just take Australia as an example. If you want to get Australia's long-term unemployment back to, get our unemployment rate back to the long-term average, so get unemployment back up to like 6%, we as a nation, we need to lose 400,000 jobs. But right now, we're adding around 31,000 jobs a month. So not only do we need to like reverse the adding of jobs, we've also got to then reverse it by a factor of 10 to basically get to a point where unemployment starts to become alarming. So again, this feeds into this whole narrative that we have that conditions are looking okay, muted, but okay. And I think that's the key point here. All right. So let's flip the slides, go to the next slide. So given this sort of view that things are actually getting better, not worse, what have we done? So I'm going to get into the more detail on this later, but suffice to say, the conclusion up front for all you guys that are listening is that we're starting to put our risk assets to work. And what we mean by that is that we're taking from our cash allocation and allocating more to the developed market equities. Now, like I said, I'm going to go into that detail a bit more, but regarding developed market that move into developed market equities, we think it's very important that you need to be nuanced when you start looking at equities outside of Australia. And specifically, what we're going to call out first is what the chart on the left is talking about. Now, I think many of you may have heard of the Magnificent Seven. So these are like the seven biggest technology stocks in the US. So this is Apple, Microsoft, Amazon, Google, Facebook, and Tesla, and especially NVIDIA. And what that chart on the left is showing is that they have that year to date, they have they have accounted for more than half of the rise in the S&P 500. So that means of that 15% rise, more than half of it was the result of these seven stocks. What that means to us is that the other 493 stocks in the S&P 500 are kind of being ignored is the way I would describe it, which means that you're getting this really big distortion going on in the US market, right? So just to help bring just how severe this distortion is, I've got some stats here, right? So if you just took the market cap of the Magnificent Seven, so these are the seven biggest stocks in the US, these seven stocks are 3 times bigger than the entire ASX, okay? And here's another one for you. If you take our biggest stock in Australia, which is the BHP, and you put it inside Microsoft, you could put 23 BHPs inside Microsoft's market cap. So I'm hoping this gives you an idea of just how large these companies are, and as a result, just how much of a distorting impact they're having on the market. So why are we talking about this? First of all, we know that the S&P 500 is up 15%, but as I've just highlighted, most of that growth has actually come from these seven stocks. And that's fine as long as those seven stocks keep delivering on earnings growth, okay? And this is the part where it starts getting a bit awkward. So take a look at the chart on the right. This is a very simple way on how market practitioners usually look at the market to sort of figure out, do stocks look expensive or cheap? Very simplistically, the market will pay for profits, and they will pay more for profits that are growing. And what you can see here is that there's a very clear linear relationship, meaning that the better the profit growth is, the higher the multiple that you want to pay. That makes sense, right? However, what we're finding with the Magnificent Seven is that this relationship is actually starting to get pretty extreme, right? So let's just take NVIDIA, for example. NVIDIA, the market is expecting that NVIDIA is going to grow profits by 100% next year, and as a result, are paying a 47 times PE. If you were to put that on the chart, you'd see that it's not only off the chart, it's like in the room next door in terms of how far off the scale it is. And therein lies the problem, right? Is that the Magnificent Seven, because they're trading on such big multiples, the way that we describe it is that these things are priced for the perfect delivery of very ambitious growth estimates. And the problem here is that you just need to have even a small disappointment to have a pretty big sell-off on any one of these stocks. And so that's why the risk return in our mind isn't quite as attractive as maybe the more prosaic end of the market, where you've got the Topix, which is Japan, and the Euro stock, which is Europe, where you're still getting some pretty good double-digit returns and a far more reasonable multiple. So in our mind, we would rather go to sort of the boring end and only get double-digit earnings growth and only pay low double-digit multiples, as opposed to sort of take a bet at the other end. So I hope you guys sort of appreciate that nuance. Now, one thing I do want you to remember, and we're going to refer to this later on in today's presentation, is take a look at where Japan is and how it sits sort of in that fair channel, okay? I'm going to come back to that point in a moment. Now, just one last thing on this slide before we go any further. If you look at the chart on the right, does any one of those sort of regions of country kind of stand out at you in a bad way, right? And obviously the answer is the ASX 200, right? The ASX, for its level of earnings growth, should not be trading at the multiple that it's at. Basically, what it says is that it looks like bad value. You're paying a lot and getting very little in return. And that's a bit of a problem. And that also explains why the Australian stock market has underperformed global equities, so the MSCI ACWI year to date. The ASX is only up around 4% year to date versus the MSCI ACWI, which is up more like 11. And quite frankly, this underperformance by the Australian market is something that my team has not gone unnoticed. And it is a live debate for my team right now. What do we do about it? Do we continue to wear this pain and hang in there, or do we just cut our allocation to Australia and recognize that it may continue to underperform? The reason why we think that it may continue to underperform is that if you remember, what are the two biggest components of the ASX 200? It's the banks, it's the resources. The banks have already had their big re-rating because the recession that didn't come meant that all those provisions for credit losses, all that stuff is being written back into earnings, and as a result is going back into dividends, and as a result has seen bank stocks already rally. For the market to go higher again, we now need the resource sector to come into play. And the issue here is that iron ore is already still at about $100 a ton in China. You need iron ore prices to move again materially higher. It's something like that 150, 160 level before you're going to be able to see a big lift in earnings growth overall for the ASX 200. So look, the bottom line here is that when you're thinking about developed markets, one, we definitely have a preference for Europe and Japan over the US. And when you look at equities overall, we haven't made the call yet, but you guys will be amongst the first to know that we have some question marks about the underperformance in Australia and whether or not this is actually going to continue. But that still, stay tuned. We will have more on that hopefully in the coming weeks and months. Okay, so let's just go a little bit deeper into the case for Europe and Japan. Now, the investment case for Europe is quite simple, and that's what the chart on the left is talking about. We're just observing improving purchasing manager index readings. So again, remember earlier we were talking about the purchasing manager, the PMI reading in the greening chart. This is that same chart, but in a line form. And what you can see very clearly is that whether it's the services sector or manufacturing, which are the two halves of the entire economy, it's all getting better. And whenever you have both of those things happening, surprise, surprise, corporate profit growth is also getting better. So that is a very simple dynamic that we want to jump on. The economy is getting better, profits are going to get better. However, of course, there's a political element to what's going on in Europe. There is the rise of the right. We are seeing more right-wing parties. However, the thing that we want to call out is that whether you're looking at France or you're looking at other countries within Europe, all the polls point to the formation of minority governments. And again, this is no more stark and real like what's happening in France as we speak, where Macron's Ensemble party is combining with moderates from the left to basically put up a very strong resistance against the RN. And as a result, because of the elections, because of the second round of voting that happened over Saturday, it's very clear that none of the left, right, or center, nobody's got a majority. And what you have is a minority government. Now think about that. Is that really a bad thing for Europe right now? Well, not really, because despite the rhetoric that whether you look at the hard left or you look at the hard right, where they got all these sort of crazy spending plans, if you don't have the numbers in government, it makes it equally hard for you then to actually put policy through. And that's the key point we're trying to make, is that for all the political risk of whether it's the rise of the right or now the rise of the left, it doesn't really matter from an economics perspective, because unless one of those two sides can form an outright majority, it's going to be very hard for the Europeans to change their monetary policy or the fiscal policy. So our thinking is that political risk in Europe is being overplayed, and what we focus on is that the underlying economy is doing just fine, and that's what we're leaning into. Now let's take a look at the chart on the right. Why do we like Japan? So what's really driving Japan has been the weak yen, right? The weak yen has been supercharging exports. Exporters make up a disproportionate share of the Japanese stock market, which means that there's something like 30 or 40% of the Japanese stock market's capitalization is actually tied to the export sector. So getting exposure to that weak yen and the lift that we've seen in corporate profits, specifically around exporters, the Topex is a great way, and the Nikkei 225 and the Topex is a great way to get exposure for that. In fact, the weakness in the yen has been so bad and exports have gone so well that this has now pushed the Japanese stock market to a new all-time high. Okay. Now, I think some of you guys are probably as old as I am and we remember when Japan was the greatest economy in the world back in the 80s. Well, it's taken them 35 years to finally get back to that all-time high, but we're finally there. And our view is that it's only going to get better for the Japanese. Quite frankly, the Bank of Japan, they're not like other central banks in developed countries. They're not in a hurry to raise interest rates. Interest rates in Japan are still effectively zero, which means that the weak yen is likely going to persist, right? And as a result of that, that means the dynamics that are helping the exporters and export profits should continue to build, right? That dynamic should persist. Now, here's one subtlety that we want to call out. So remember this chart that I showed you before. Remember how the Topex, honestly, if you were to look at this chart in isolation, it doesn't look great. Like, why would you buy Japan when Europe is clearly better earnings growth and cheaper? The reason for that is that the corporate profits in Japan have been going so well that not only are current estimates going up, but forward estimates are going up. So what I'm saying is that if you look at corporate profit estimates for 2024 and 2025, they're both rising in tandem. So that means the year-over-year comp looks like it hasn't changed, but the reality is that overall profits for both time periods in the last 12 months have already risen 9%. So if you think about it, in the last 12 months, corporate profit estimates for 2025 versus 2023 have risen 18%. So Japan is already sort of factoring in some pretty aggressive earnings growth that has been delivered. So that chart on the earlier chart with the Topex, if you make that adjustment for the fact that both 2024 and 2025 are both rising in tandem, it means that Japan is more into the cheap column than the fair value column, in our opinion. And as a result, we prefer Japan and Europe. Okay. So let's pivot now. Let's talk about inflation. Now, the good news here is that it's clearly decelerating. Okay. And we are reasonably certain that developed market central banks are broadly poised at the beginning of the rate cutting cycle. We've already seen the Bank of Canada cut rates. We've seen the European Central Bank cut rates. Now, the US Federal Reserve, they're starting to look pretty good to start finally cutting rates in September. However, again, a bit of bad news here. Who's sort of standing alone by themselves? And again, it's us, unfortunately. You look at the May CPI readings or the May Consumer Price Index readings, it came in at 4%. This was up against 3.6% in April. Clearly, inflation is going the wrong way here, okay? Now, before I go any further, I just want to be very clear about this. We still believe that the Reserve Bank of Australia or the RBA, they're going to hold interest rates for the foreseeable future, okay? So that is our base case. However, something that we as a firm are watching very carefully is the impact of the stage 3 tax cuts, because we feel that potentially this is the next shoe to fall in terms of being inflationary. Okay. Now, the stage 3 tax cuts, they started on the 1st of July. Now, for those of you like me who have our PYG accounts, those tax cuts have started to flow through. We estimate that something like $15 billion of those tax cuts are going to get spent into the economy over the next 12 months. $15 billion is equivalent to 0.6 of GDP. Remembering that long-term GDP growth in Australia is between 2 and 2.5%, 0.6 is pretty material, and we haven't even considered any sort of multiplier impact, on that. Now, economics 101 here. What is a multiplier? Just remember, so when I go and spend $1, that $1 becomes somebody else's wages who they then in turn spend it again. So you can see that that 0.6, that even if we were to apply a modest multiplier, could have a very stimulatory impact on the economy. That much stimulus could lead to the economy overheating, which could lead to the RBA having to raise interest rates rapidly. Now, again, I'm not trying to be alarmist here, but this is something that we are watching, right? Because our view is that it's probably going to take a pretty colossal effort to get the RBA to raise interest rates. But the risk, of course, because clearly if they were to raise interest rates, it could potentially materially unsettle the mortgage market. And quite frankly, I just sort of look at all you guys out there, all of you guys with a mortgage. Do you think any of you could take another 3% increase in your mortgage rate, right? And therein lies the problem with the RBA. So again, our view is that yes, the stage 3 tax cuts are coming through. We think it may be mildly inflationary. However, there is a scenario where it could be extremely inflationary. We're not there yet. What we need to watch for is this year's reporting season, which is kicking off in the next few weeks. Listen to the trading updates from discretionary retailers and their outlook statements, and let's see if we can get a sense of how much of those tax dollars are actually, those tax cuts, are actually finding their way into the economy. If it's mild, then yes, rates stay flat. If it's extreme, that Australians are spending up big and we're leading to an overheating economy, then that's a different scenario. And we're going to be back to this group to update you guys on how we're positioned for that. Okay. Now, this brings us to the chart on the right. This is actually a very key aspect of this cycle that we think a lot of people are missing. This is the first time in 25 years that the US Federal Reserve will not be cutting interest rates due to a crisis, right? Back in 2000, it was the dot-com crash. 2008, it was the global financial crisis. 2020, it was COVID. In each case, the Federal Reserve had to aggressively cut interest rates to basically keep the wheels of commerce greased and running. This time around, it's not there, right? That means what we're seeing is that if the Fed starts to ease, they're doing so because they're simply just trying to, get their settings back to neutral. They were too tight and they're moving back to neutral. This is just a normal sort of cutting cycle. The point we're trying to make here is that you don't need the Fed to cut interest rates to see the market go higher, because as we were alluding to in the first few slides, corporate profits are doing just fine. And so a lot of people right now, if you look at market commentators, are so focused on, will the Fed cut in September? Will it be 2 cuts? Will it be 3 cuts? Well, it doesn't really matter because there is no crisis. We are at late cycle, yes, there is no crisis, and corporate profits are improving on their own. As long as corporate profits keep improving, which they seem to be doing, the market can go higher with or without the Fed cutting interest rates. And I think that's the key thing you need to be thinking about, okay? All right, so flipping the page now. Let's talk about fixed income markets. This is actually something that we think is people should still continue to be focused on. And this is what the chart on the left is talking about. I always start this chart by asking people the question, where's the fire? Right? And the reason why I say that is because what you're looking at is some analysis done by the Congressional Budget Office, or the CBO, on the US government's fiscal path. Now, the CBO is a bipartisan group. They've been around for decades, so they don't really, they do this for all governments. But the point being is that the CBO is pointing out that only during the Second World War and during the coronavirus pandemic have you ever seen federal debt at these sort of levels. And so this comes back to my first question I said to you guys, where's the fire? What existential threat is the US government dealing with that necessitates such largeness by the federal government? And the simple question, there isn't one. And that's problematic, because if they keep spending like this, you can see how that chart is just going completely into uncharted territory, right? And rising public debt is actually code word for increasing supply of US government debt. And this comes, therein lies the problem. If you have increasing supply of something, you need increasing demand to soak it up. Otherwise, prices go crazy. So let's take a look at demand. Who buys all of this US government debt? Well, it's very simple. There's three people. There's the Chinese government, the Japanese government, and the US government itself. They are the three largest buyers of US government debt. We know that China has actually turned to become a net seller of US debt. They've stopped buying debt, American debt for some time now. The Japanese, because the yen has been so weak, are unable to hedge their exposure to the US dollar, so they're unable to buy more US dollar debt. And remember the US, remember when they ended easing? Sorry, when they ended quantitative easing, that ended 2 years ago, which means that they stopped buying US government as well. So that means the three largest buyers for the last 10 years of US government debt are no longer in the market, which means that the rest of us collectively have to now start soaking up all of this debt. And that is the point we're trying to make. We think that the time is coming where the market is going to look at this sort of irresponsible fiscal path of the US government and then they're going to then start pivoting to other countries that may have more sustainable debt positions like Australia, where clearly the chart on the right, which came out of the most recent MYEFA report of the mid-year economic and fiscal outlook forecast, where countries like ours can show a credible path to bring our debts under control. And the stark choice between one country that doesn't seem to have any restraints on increasing the supply of its debt versus another country that is being fiscally responsible, we think that that's going to lead to a relative outperformance by fiscally prudent countries like Australia versus the US. Okay. Now, just to be clear, this is a relative call that we're making. Okay. We think that we have to acknowledge that the economic gravity of the US debt market is so large that if US rates move higher, interest rates around the world are going to move higher as well. But if the US interest rates were to move by, say, 2%, maybe ours only move by 1%. And so there's that relative preference in our mind for Australian debt over US debt. Okay, I hope that wasn't too technical, but that's just something that we think people should be thinking about at this point in time. And just one more thing before we get into positioning and portfolios, the case for small caps. So again, we were talking about how we've got a preference for developed market equities. We also have a preference within developed market equities, not only just in Europe and Japan, but also small caps over large caps. And the reason for that is that traditionally, small caps tend to start to outperform early in the economic cycle or just as the economy shifts into expansion, right? We also, and that's what the chart on the left is also showing, is that typically the US small caps actually start to outperform just as the US Federal Reserve starts to cut rates. So as the US Federal Reserve is about to start cutting rates, we think that will be the starting gun for small caps, US small caps in particular, to start outperforming, okay? Now, people will extend that analysis. Well, how about Australia? Should we be buying Australian small caps? We say no. The reason for that is that Australian small caps aren't particularly cheap. They're still trading at around 18 times forward PE versus their long-term average of 15, whereas the US is actually trading at a pretty big discount to its long-term average. Okay. So look, given all of what I've just said, talking about the improvement in the world economy, talking about our preferences within developed markets, talking about fixed income and small caps, how does all of that then translate into client portfolios? And that's what this is talking about. So this is our strategic asset allocation with our dynamic asset allocation overlaid. Now, if you had looked at this chart probably about a year and a half ago, you would have seen those white dots under growth assets more to the left, and you would have seen the white dots under defensive assets more to the right. So you would have been underweight growth assets, overweight defensive assets. And that would have made sense because we were faced with some pretty dire recessionary condition outlooks, right? But today, what you've seen is that our dots are moving to the middle and in fact are now starting to swap. right? So within our growth assets, you can see that now we're kind of pushing everything more towards overweight, and our defensive assets are now pushing more towards underweight. So that includes cash. And again, remembering my opening comments, we are entering a period where we're seeing an improvement in macroeconomic conditions that while they may be muted, they are still positive nonetheless. And the risk of a soft landing or even a hard landing seems so remote that we want to start putting our risk assets to work. And so that's what that orange dot is talking about. We've now reduced our weight in cash and we've allocated it to developed market equities by moving more into large caps. Okay. But within the large caps, again, just to reiterate, we prefer Japan and Europe exposure over the US. And even within developed markets, we have a preference for small caps over large caps, which is basically code word for buy US small caps, avoid US large caps. Okay. And again, to the other point, when we are talking about a relative preference for Australian bonds over US bonds, you can then understand why we're slightly overweight Australian bonds over global bonds. And just as a final point to end off my prepared comments, we still maintain an allocation of gold. Gold does what it's supposed to do. It zigs when the market zags. It's a risk diversifier. If things suddenly were to get worse in Gaza, if things were to suddenly get worse in Ukraine, if aliens were to land in Australia, gold's going to go. And that's why you always have a small allocation of gold in your portfolio. So look, that's the end of my prepared comments. I'm happy to now sort of flip over to Q&A. Nigel, do we have anything in terms of any sort of preset questions?
No, yeah. Would anybody like to, if you would like to ask a question, you can either type it into the Q&A or on the top of the bar there, you can see raise hand. So if you do that, we can then let you ask a question. So either way, feel free. Trish, you got a question?
Hi, Nathan. Yeah, hi, Nathan. It's Trish. Can we just go back? You said you wanted to go back to that slide at the beginning after you referenced all of that information, which was fabulous. Thank you. Can we just go back to that slide that we didn't cover off? Because you said you were going to go back to it, and I'm just curious as to why.
Sorry, which slide again?
It was, I think it was the summary.
It was the first slide. It was the summary slide. You said you've got to read the summary slide at the end. Yeah.
You wanted to read the summary slide at the end.
Yeah. So basically, what you can do now is that everything I just said should now make a lot more sense to you because these are the key messages that you guys should be taking away from the presentation.
Great. Thank you.
So looking at the Q&A, is the deck available after the presentation? Absolutely. Is 40 degrees before or after wind chill? Before. Wind chill, it'll take it down to 43 or 45. It's horrible. I don't know about you guys, but I've actually been in -40 and it's so cold the water in your eyes start to freeze. Okay. It's pretty bad.
Okay, so any final offers for any questions?
You got
Anthony. Hold on.
Oh,
there you go. Anthony, do you want to unlock and ask a question?
Yeah, all good. Thanks, Nathan. That was fantastic to just get your thoughts. Just curious, your I guess your high level thoughts on macroeconomic tensions in the Middle East, and I guess with a lot of elections globally this year, do you sort of see that throwing any spanners in the works potentially?
Okay, so quite frankly, we know the stats, right? Something like 50% of the world's population is going into elections this year. But quite frankly, the only one that anyone seems to care about is what's happening with Biden and Trump, right? Now, it's very clear Biden had a disastrous debate with Trump. Trump gave him so many openings, just purely, I'm not Trump or Biden. I'm just saying that anybody could have actually taken Trump apart pretty easily in that debate, and Biden just fell flat on his face. As a result, it looks increasingly likely that if nothing changes from here, Trump's going to come into power. So if Trump comes into power, the key sort of policy platform that he's been talking about, that most people are focused on, is that his plans are based on increasing the deficit, which comes back to that chart we were talking about earlier about how the U.S. deficit is already on a pretty severe slope. That might bring that dynamic that we're worried about to the fore, which means that, again, we're already positioned for that because we prefer Australia over the US. So that's a tick. But the other one that people are thinking about is that what if Trump were to apply 10% tariffs across the board, not just China, but against everybody? And the reason why we're not too worried about that one is that Trump caters to the middle class. The middle class in America is currently suffering through a cost of living crisis. If he were to put a 10% tariff across the board, that is going to immediately hit the hip pockets of his constituents. So the idea that he would do such a policy, we think in our mind, for as rational or irrational as Trump is, we think that's a non-starter. Because once he starts modeling that out and people start realizing, holy smokes, my paycheck isn't going as far anymore, and it's because of Trump's policies, we don't think he's going to do that. So our view is that at this point in time, there isn't enough meat on the bone, specifically on Trump's macroeconomic policies, to really be buying or selling into it. I'm just going back to the fundamentals, and the fundamentals right now are telling us that America is doing just fine with or without Biden or Trump's help. If we actually get something definitive, then we're going to have to adjust. But right now, it's all rhetoric. Trump is just making a lot of irrational noise, and his policies don't even make any sense, right? So in that respect, I'm not too worried. I'll finish off your question lastly, just in terms of the Middle East. Our view here is that this has become a simmering back to status quo. It's pretty clear that Iran and the U.S. are not interested in a broader Middle Eastern conflict. We've seen there was some the whole military action in the Gaza and the West Bank is clearly winding down. There has been some agitation on the northern front with Hezbollah coming in Lebanon, but clearly the Israelis have no appetite to invade or to expand this war. So our view is that at this point in time, the wars both in the Middle East and Ukraine are unfortunately, from a purely market perspective, neutral. They're kind of like a standstill. Human cost, horrible. I'm not diminishing that. That doesn't change. But from a market's perspective, we're not positioning our portfolios to account for that. Anthony, does that answer your question?
Yes, thank you very much.
Great. I'm looking at some posts here. We got one here from Josh. Hey, Nathan, do you have any allocations to China? Thoughts on China growth slowing? Okay, so one, yes, absolutely right. China is slowing. That has been happening for a while. But the more interesting aspect of that is that if you look at the broader Chinese economy, it's only the property sector that has really been going down. Now, of course, we know that the property sector makes up a third of the Chinese economy, but outside of the property sector, whether you want to look at technology or industrial production, the rest of the economy is going fine. So unfortunately, I think the best way somebody described it to me is that the parts that are doing well in China don't really help us, right? And what I mean by that is you see that, yes, steel production is still high, but what's happening is that China is actually just dumping that steel into the export markets. They're not selling it actually at commercial terms. They're just kind of dumping it. And in the long term, you can't just keep dumping steel below cost. So our concern with resources, and this ties into this broader narrative that we have around Australia, is that if the banks have already re-rated, and it seems unlikely that the resource-intensive parts of the Chinese economy are going to turn anytime soon, that this is another reason why we don't want to be in Australia. But again, we haven't made up our mind on this, but I'm just giving you a bit of an insight on what we're thinking about China and Australia right now. In terms of your last question, in terms of allocations to China, we basically follow the ACWI, right? So we're either overweight, underweight versus the ACWI. At this point in time, we're basically neutral China weight in the ACWI, but we're not prepared. About 6 months ago, we were actually underweight China. We're now neutral. We may have gone probably a bit early on that call, but for us to go overweight, we're not there yet. Moving on to the next question. What do we got here? A lead. What's the definition of small caps? Small caps. So small caps are, so when you think about companies, they're either big or small. So they're either large cap or small cap. Small cap in Australia is typically companies with a market capitalization less than 200 million, right? That's kind of the rough rule of thumb. However, when you go to the US, small cap is more like in the multi-billions, right? Like their small caps is our mega caps, right? So it's a relative term. So when we say small caps, you do have to sort of put that qualitative lens. So when you look at the US, when we say small caps, basically what we're saying to you guys is buy everything other than the Magnificent Seven. I hope that's a clear enough explanation for you, Alid. Matthew, thoughts on real estate exposure in the current market, high level, Aussie versus global. Okay, first of all, the Australian property listed market is basically Goodman Group. That's just the reality of it. And so you got to make a call on Goodman. Goodman are more like fund managers than they are property developers anymore. So it's a very hard call. If you want to get more granular, though, and you look at sort of end markets, and I like to break it down by office, residential, or industrial, office is clearly where you don't want to be, right? Office, whether it is in Australia or overseas, are still under a lot of stress. Now, what we've seen anecdotally, that transactions are happening on average about 20% below book values. So you are starting to see some grade A property in Australia being sold at around a 20% discount from their last sort of valuation. However, what we're also aware of, and this is what the property lease agencies are telling us, is that the incentives are still incredibly high for even grade A property, meaning that we've heard of incentives as high as 30 or 40% for someone to take on a lease in an A grade building. Now, you really need to see those incentives come back to something more like in the little single digits or to just disappear in entirety before we as a firm are going to say all clear in the office space. Industrial space, that's fine. There's nothing to really talk about there. That's really the thematic that Goodman has been riding for the last 10 years. It's very much the same thematic that is driving the Magnificent Seven as we move more into a digital environment, as we move into more of a diffused supply chain. We're going to need more warehouses. We're going to need more data centers. So that's a good space to be. And the last one, residential. Well, residential, again, I don't need to talk to you guys about that. Everybody in Australia is pretty much an expert. Suffice to say, residential property in this country, it just goes from strength to strength because we don't build enough. And as long as we don't build enough, property prices are going to get underpinned by that supply-demand imbalance. I hope that gives you a bit of a high level there, Matthew. All right, Jackie. How do we feel Japan is now setting the precedent for future market movements and direction, considering for a very long time they've been left siloed, decreased population, and deflation? Okay. Absolutely right. So let's take each one of those in turn. Decreased population, absolutely right. They're the first developed market to have a shrinking population, but the Japanese have now started to change their views on migration. You're starting to see a lot more foreign workers. I was just in Japan a couple of weeks ago in Tokyo and Kyoto, and the one thing that struck me is the number of Indian and other foreign workers that are appearing at every level of their society. There's definitely been they've talked about a policy change on migration, and clearly they're relaxing that because they recognize that they need to get people back in their economy, and that's going to help mitigate some of that population decrease. Deflation, that's ended. That really came about in the last 5-6 years under Abenomics, where he basically took the corporate sector in Japan and shook them up, and basically under the guise of corporate governance, code word for, hey guys, stop treating your shareholders like idiots, start firing people, start thinking about returns, start thinking about dividends. And as a result of that, you've seen corporate Japan respond, and you're starting to see it. And the best way to measure that is you can see corporate ROEs in Japan rising quite sharply as that culture of we need to let things fail to let things grow is starting to manifest in Japan. So that dynamic, which unfortunately they lived through for so many decades, is now very squarely in the rearview mirror. And to your last point about siloed, I would disagree. Other than probably retail investors, institutional money has been pouring into Japan and has been for some time now. Our view is that that's going to continue because of that corporate dynamic, which has been really improving in the last few years in Japan. All right, I think that's all the questions I got so far. Does anybody else have any other questions, or does anybody want to follow up? Do we have any hands out there? Or if anybody, I answered a question, but you felt I didn't answer it, I'm happy to clarify.
I think you answered them pretty well, Nathan. So I think unless there's anybody else, I think we'll finish up there. So look, firstly, just on behalf of everybody on the call, I want to thank Nathan for the presentation. Really informative, a lot of information. But I always find it valuable to find out what's going on from the professional. So we really appreciate your time today, and for Ben, who's in the background for arranging that on behalf of Lonsec. From our perspective, we now partner with Lonsec and Nathan and his team to provide investment solutions to our clients. So it's a developing relationship that we're working through over the next, from here on in, which is great. So we really appreciate that relationship and you supporting our clients through that process as well. We'll be sending a copy of the slides out post-meeting in a day or two. And if you have any further questions as a follow-up to this for the clients on the call, just please give your advisor a call and they'll be able to help you out. So again, many thanks for taking the time during the day to join. Thank you, Nathan and Ben, for providing that great presentation. And we'll wrap up there. Thank you very much.
Thanks, Nigel. Bye, everyone.